Ready to pass the CPA exam faster? Visit cpapass.ai. Today, FOB shipping point versus destination. Who owns transit inventory on fare? Why does inventory cutoff matter so much on the fare exam? It directly impacts a company's bottom line and tax liabilities, especially under LIFO. In periods of rising prices, using the last in, first out method provides massive tax savings. It improves cash flow by matching current, higher costs against current revenues. However, to secure these LIFO advantages, you must master the year-end inventory cutoff. If you misstate your ending inventory because you misapplied shipping terms, your cost of goods sold and net income will be completely wrong. This is where examiners love to test you. Physical possession at year-end does not equal legal ownership. We must look at the shipping terms to determine who legally owns the goods in transit. And let's look at FOB shipping point. Under these terms, title and risk of loss transfer to the buyer the moment the goods leave the seller's shipping dock. This means if you are the buyer, you legally own those goods while they are in transit. Even if the shipment is floating on a cargo ship on December 31st, it must be included in your ending inventory. For a LIFO adopter, including these late year purchases can be crucial to avoid liquidating older, cheaper LIFO layers. Additionally, the buyer pays the shipping costs known as freight in. You must capitalize freight in directly into the cost of inventory, which further builds your asset base and ultimately your LIFO cost of goods sold. Now contrast this with FOB destination. Here, title and risk of loss only transfer to the buyer when the goods physically arrive at the buyer's location. If goods are in transit on December 31st, the seller still owns them and must include them in their ending inventory count. For the seller, shipping costs are classified as freight out. This is treated as a selling expense on the income statement, never capitalized into inventory. Under the LIFO conformity rule, if a company uses LIFO for tax purposes to get those cash savings, they must also use LIFO for financial reporting. This makes precise year-end cutoff under FOB destination critical to ensure both tax and book inventory figures align perfectly. Let's walk through a concrete exam scenario. A shipment of goods is sent on December 30th and arrives at the buyer's warehouse on January 2nd. Who owns this inventory on the December 31st balance sheet? If the terms are FOB shipping point, the buyer owns the goods in transit and must include them in ending inventory. If the terms are FOB destination, the seller owns them. If the buyer mistakenly omits these FOB shipping point goods, their ending inventory is understated. This triggers the seesaw rule. Understated ending inventory overstates cost of goods sold, which understates net income. This inverse relationship confusion is a major examiner trap that will cost you easy points if you forget it. To wrap up, let's master the top examiner traps. First is the consignment trap. Consigned goods always belong to the consignor, who is the original owner, and never to the consignee holding them. If a question mentions a retailer displaying goods for a manufacturer, exclude those goods from the retailer's inventory count. Second, remember the LIFO conformity rule. If LIFO is used on the tax return, it must be used on the financial statements. Finally, remember that LIFO is a no-go with IFRS. International standards completely ban LIFO, meaning only FIFO or weighted average are permitted. Keep these rules straight, practice your cutoff scenarios on cpapass.ai, and you will easily secure these points on your fair exam.